Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Welcome back to the Australian Retirement Podcast, episode 2, Drew. We're into it now.
Good to be here as always.
Today we're going to be talking about how to start planning for your retirement. So got lots of cool stuff to talk about here, but I think the very first place for us to start, of course, is the idea of asking the question, what are we actually looking to achieve with retirement?
Exactly. And that's, I mean, we've talked about in the first episode, what's the biggest question people ask and what answer they want? And it's usually the answer we can't give them. And so much of it is just about framing what retirement's going to look like. As you were talking about, it's hard to do that from when you're 40 and it's so far away, but there are little goals you can set along the way. And it's very much about understanding the differences in people's lifestyles and helping them come to some sort of conclusion of what their retirement will look like. And lots of questions and lots of guides along the way in doing that. I think the big question that always comes up is, and I hope this is a simple answer, it definitely is for me, but when should someone start planning for their retirement?
Yesterday.
I was going to say now. Okay. So we disagree. We're allowed to disagree too.
How refreshing.
And that's something people constantly forget about. Like you meet clients from their mid-40s onwards. We generally work with people in their mid-50s onwards. And so many people just go, oh, what's the point? It's, I can't touch my money until I'm 65. What do you say to that?
You're wrong. Yeah.
And how do you even get them to engage on that?
Well, this is, I think everyone would, regardless of where you are in your retirement journey, you'd agree that it's important. The distinction, as far as I'm concerned, for a 55-year-old is that it's not urgent. You can wait. And so there's lots of great things in life that are important and not urgent. Your health and well-being is a good example of that. The quality of your relationships is something that doesn't necessarily need to be resolved right now. Yeah. Everyone's always got spot fires in their lives and things that are in that important and urgent quadrant that needs to get looked at right this minute.
What TV show to watch on Netflix tonight? Like those sort of really pressing issues.
The things that really change your life, correct. And so, from our end, we really want to be bringing forward that it's true that this is not urgent, but part of planning is that the sooner that we can act on this, the more impact we're going to have.
I think something I've realised over 19-year career would be that Australia is quite unique in the ability that anyone can basically control their entire retirement savings, whereas most countries still work on a defined benefit system, which means you're paid based on how much you worked, what income you produced. In Australia, we're almost solely defined contribution, and probably one of the biggest things why I say you should start thinking about your retirement as soon as you're working is because you're forced to put away, I think it's 11.5% at the time we're recording. Yeah. So essentially, depends on which way you look at it, you're losing 11% of your salary to put forward to your future self. So why wouldn't you start thinking about retirement and what to do with that money now? I think that's probably one of the most powerful messages I give to I can't really call my friends young people, but
no, you cannot. You've got no right to do that.
And then like the next step after, the true answer to when you retire is, as hopefully you're going to explain, is how much do you actually need to retire? Because you can't tell when you can retire unless you know how much you're going to need.
Yeah, spot on. The topic of when can you retire, I'd be keen to hear how you guys solve this, but when people come to us and ask that question, we firstly want to get a really clear understanding of what sort of retirement lifestyle you're going to have. And there's lots of ways to do that.
Do you have an index that you use?
No. We use budgets. Yeah. So we'll look at your current expenses and then we're making some changes to that to provision for the fact that your groceries might go down because you don't have your kids still living with you, for instance, but your holidays will go up significantly because you'll have more time. So we're making those kind of adjustments.
Did you know there's 3 types of CPI? Have you seen? There's retiree CPI and there's accumulator CPI.
No, tell me about this.
Yeah, so if you go on to the ABS website, so the Australian Bureau of Statistics, they actually break down the inflation basket of goods for different cohorts of people. And in the last 12 months or so, you've had inflation for people over 65 lower than people under 65 or in that next cohort. Part of that is rental prices and all those kind of expenses have gone up. So retirees, and we don't want to, put anyone off the offside. But retirees have essentially had lower inflation than everyone else.
Oh, thank goodness, because they're getting those higher rates of return on all of
that's the other thing.
Yeah,
but it had the benefit of higher term deposit rates and higher returns than ever.
Yeah.
But I interrupted, so...
nice to have some quick wins.
Yeah, how much do you need? So inflation and cost of living is an important part of that, I'm sure.
Big time, And so as part of that, of course, with your retirement, we're going to need to self-fund that over the duration of your years.
Yep.
And there's lots of ways to self-fund that. Later on in episodes, of course, we're going to talk in more detail about, for example, age pension and some of those sorts of things. But for most people, if you're looking to really proactively start planning for your retirement, and if you've got the time, if we can position ourselves where we're not relying on age pension, that, as far as I'm concerned, that actually puts you in a much better position, certainly a more financially confident position.
Yeah, what really shocks me is the lack of any tools to calculate that. You have to go to an advisor to help you go through. And I always talk about, I hate forward-looking budgets because I've never been able to stick to one, and I find most clients can't. So you've got to understand what you spent the previous year and then make adjustments. Is it mortgages? Is it insurance that you won't be paying later on? But there's no real resource that says, based on your super balance, or this is how much given your history you'll need in retirement.
Yes.
Like there's a couple, and I think we both share similar opinions on those. Could you talk us through the ASFA, or is it the Australian Super Fund Association?
Yeah, that's right. So the Australian Superannuation Funds Association is obviously the I won't say governing body, but the peak body that would look after all superannuation funds in Australia. And they have put together their assessment of different lifestyles in retirement. As of the June 2024 date, which obviously this date might be different now, but at the time it was about $73,000 was considered a comfortable lifestyle for a couple. A modest lifestyle for a couple was about $47,000, and then it's expected. About this off air too, and then it drops down by about 10% from around age 85. Now, for a singles, it's even less. I think it's something like $33,000 is a modest lifestyle for a single, which I don't know where they get these numbers from, and I don't know what expenses they're assuming.
They had a pretty good. I looked at there was an infographic. These groups are great at infographics.
Cool. Yep.
What I couldn't really find on there was international travel. I'm sure it's the same as you, but the first question I ask, I'll trust their estimate of all their other expenses, but the first question I ask every client is, how much do you expect to travel in retirement, and will it be overseas or will it be domestic? If I'd say, and hopefully you'll disagree, or maybe you won't, that the average expenses from self-funded retirees, and we work with people who have run businesses or been, career in a certain, professionals in certain areas, the average would be around $80,000 as kind of a base level each year, and that would probably include one real trip a year.
Yeah, I think. Yeah, I think those numbers are about right. I was going to say 80 plus.
80 to 120 would be like 80, the range.
Like 80 plus holidays would be.
And this is probably a big one here, is this is tax-free. If you're talking about all this income is after tax, this is what you're getting in your bank account.
Something else that I find frustrating about these estimates, aside from the fact, again,
I
genuinely think that they're rubbish. Because I don't know what your definition of modest is, but $50,000, like $1,000 or $900 a week in today's terms for a couple, as a retiree couple, is not a lot of money.
$200 on groceries. And all these rely on you owning your own home.
Correct.
Yeah, we won't get into political debate on that.
Let's stay away from that one altogether. But one thing that I don't like about these models is that I don't believe that your income should be flat, or that your expenses should be flat. Not only will be flat, but should be flat. I note that they say it drops by 10% at age 85. Sure, we can understand why. There's less holidays, more medical expenses, of course, but less holidays. So obviously those two probably offset, and there's a little bit more that's that 10% drop. But what about health expectancy? My worldview when we're sitting down with people who are talking about retirement is, the default should be, I intend to run out of money.
Yeah.
I intend to have an incredible retirement and spend all of my pennies. And sure, if there's some extra legacy amounts, or I want to support kids, et cetera, no problem. Let's understand that well. But the best time for you to spend your money is in the immediate years following your retirement, because your health is as good as it's going to be, very likely. And the unfortunate reality of life is that your health declines in a not in a straight line,
non-linear.
Yeah, so you might have a period. We had a member quite recently who is a retiree, and unfortunately they've experienced an ear event, which is or an ear issue, which it means that they can't fly anymore, and that's likely to be permanent. Sometimes it materializes like that really sudden change.
You get a caravan.
Yeah, that's right. Yeah. But sometimes also it just comes, I'm sure you would have experienced this. You're sitting down with retirees, the narrative starts to change around travel.
Yeah.
So instead of, it's not a case that we can't do it. It's saying, oh, look, I don't know if we'll go again. We didn't sleep very well, and the flight took it out of us, and Reg found the tourist pretty annoying, and like, you are a tourist, right? You are a tourist, Reg. But what is really being said here is we're not up to it anymore, like we used to be. And when I hear those words, for me, that's a real shame, because if you have enough money to be able to travel still at that point, unless you've exhausted your psychological travel budget, you've said no.
It is exhausting.
Yeah,
3 weeks is probably enough, twice a year.
Unless you've properly done it and said no, I'm truly at peace, and there's no more that I have to do. We've missed an opportunity here.
Yeah, and I think
we're just talking about travel here. There's so many elements of retirement, things to enjoy in terms of your hobbies and your passions and relationships, etc. So for me, when I think about expenses throughout retirement, I feel like they should be peaking in years 1, 2, 3, 4, 5, and then they should be declining and then going into a more steady state, and then again they start to fall off the tail.
And that can be terrifying. Like it's non-linear, but everything you get given on retirement modelling is linear. This will be your return. This is how much you'll draw. This is what inflation will be, and that all assumes that your money will keep going up
just
in perpetuity. We've all done the same modelling every year, and that was the average return. I mean, we've kind of coined in our golden years, or the golden years book, we coined it. Most people split retirement into 5 phases. We split into 3. They're probably more relevant to spending. The golden years, the silver years, and the legacy years. And the golden years, as you said, they can be 5 years, they can be 15 years. If your health is good, you're going to spend the vast majority of your capital in the golden years.
Yeah.
The first 5 to 15 years. You're able to travel, you're able to work, you're able to babysit, you're able to do everything. You got the free time and the kind of interest in doing it. And I think one of the probably interesting data points that comes up as well is that most people don't realize that more than 50% of more than half the growth in their assets actually comes once they retire. Mm-hmm. And what you're doing here is using that growth and relying on all that savings you put together to fund a maybe slightly more egregious lifestyle in the first few years. And so most people have given up lots of free time to sock money away for retirement. And then it does quickly go off, probably a bad word, but it does quickly fall off a cliff. Your silver years, you're very much more home focused. You end up being more restricted on where you can go. Maybe it's more domestic travel. Maybe you've got grandchildren and all those responsibilities start to come in.
Yes.
And your expenses fall significantly. And then you get to legacy, and that's where things like aged care come in. And you go from having travel to basically having health expenses most of the time. So it's very difficult to model that. And I'm sure most of your advice is around how do you maximize the probability of being able to afford those different situations. So you can assume it falls or drops 10%, 20% at different points, but every person's situation is going to be different. So how do you build a strategy that helps to navigate and maximize probability that you'll have that $0 left on the day that you pass? I think that's impossible. But
it would be quite a feat. Yeah. But to add to that too, part of this conversation also depends on the person that you're sitting with. So, for example, if you're sitting down with someone who is quite data driven and has a little bit more faith in the maths, then they might be a little bit more confident to say, look, let's deplete it at the front end because, all this makes sense. And it's true that the returns aren't going to be consistently 7.7. They'll be all over the shop.
That's I'll get that one off my chest too.
Correct. But what we can do is we can, we can adjust as we go. But right now, there's no need not to be a little bit more courageous with our expenses and do some of those things. Yeah. Other people, like if we're trying to run out of money, so to speak, that means there's going to be a long tail in the final 4 to 5 years where there's probably very little money, much less than they're used to. And you don't want your final years to have any element of financial stress. In fact, that might result in your final years being a little quicker, which is not necessarily what you're after. So it is a balance.
I think if you look at how do I start planning for retirement, there's probably there's the two big questions are, how much what expenses do you expect to have? You have to answer that question first. And stage 2 would be to identify and locate all those assets that are going to be used to fund that. I think that we almost tend to forget about probably the first step and just focus on the second step. Let's accumulate as much as we can. I think I've found something that people tend to struggle with is how do they account for different expenses, and how do you keep in mind if you own a property and you're in that strong position that is actually an asset that can be used at some point in the future? Do you work on that with clients? Is there?
Yeah, great question. It depends on the individual. If we're sitting down with someone where, for example, they might have today's dollars $2.5 million home, they're doing remarkably well. They've got no debt, and the home is really large. They're going to need to downsize. We'll talk to them about what your best guesses are around a downsize. Yeah. And they might say, look, we'd rather, we're going to go Bayside. Hopefully downsize. Depends on whether or not you want to scrape in for age pension, but that's another gripe that we could talk about.
Yeah.
So if we're downsizing, what's your best guess around what that might look like? Bayside, single story, for example, like those kind of things, for instance. Okay, cool. That's what we're going to do. So then it's reasonable to think that at some point, let's say in a decade, there'll be some money freed up, and we take a conservative estimate and consider that in the modelling.
Yeah.
Alternatively, if we've got someone who has a beautiful home with a value of, for instance, $1 million or thereabouts, we might say, well, with your downsize, that's really likely to be like for like.
Yeah.
So if anything, we might even incur some cost there depending on what you're looking at, like in terms of selling the property and purchasing a new property. So circumstantial, but generally speaking, we would tend to leave it out and do our best to ensure that we can self-fund using your assets excluding your home.
Yep.
What's your approach?
I've seen a lot of situations where people view renovations as like annual expenses. Well, I mean, for some people, maybe they are, but I'm very big on accounting for capital and kind of discretionary expenses. Capital is where you're adding value to an asset that you have. I think depending on the people that you're working with, I see your home, and I'm probably less attached to homes and as much as a lot of people, but it is another asset you can use to fund a retirement. Like we've worked with people that have, say, a $2.5 million home, but only $500,000 in superannuation, and the equation is pretty simple. I think a lot of people refuse to say it, which is, you can run down your investable assets, your liquid assets, but at some point you're going to have to release the equity in that home. Unfortunately, Australia isn't great for things like reverse mortgages and the ability to equity release, which I think we're not necessarily proponents, but I think if people are able to extract that value from their home at some point in the future, and I'm sure that market will kind of continue to evolve.
It's there, but it needs work, doesn't it?
Yeah, and it's not necessarily that tilted in there to the benefit of the homeowner yet. But I think it's just considering that you put all your assets together. Is there a holiday home? It's always complexity. Those things just cost money, and land tax is going up if you're based in Victoria. So considering all those assets as part of your net worth and thinking about how they could be shifted to fund lifestyle at different points. Because I think a lot of people that are retiring now or have been retiring haven't had the benefit of super guarantee contributions that came in 91, 92. And hence a lot of their assets are built up in the form of property and other parts of their portfolio.
If we're talking about cash flow here, it'd be remiss of us not to talk about buffers.
Yeah.
So do you have a house rule in your business? What's the approach that you take for people?
We tried a house rule, like a percentage. And when we're managing an investment portfolio, we'll see cash as an investment within that.
Yep. But
we've found, this idea of sleep at night, and part of one of our golden rules, we love everything golden, is we think every client needs to have a liquidity bucket, and that number it could be very different for anyone. For some people, having $10,000 in the bank to know that if something goes wrong with a car or a house or anything, they'll have it. For some people, it's like 12 months, 18 months income. So we'd start at a general rule of 18 months in cash, and then we dial it up and down from there. But the ultimate one is everyone has a number, You will see this too. Everyone's got a number for when we send a quarterly report about their portfolio. If it's below that number, you're getting a phone call. Everyone has a number on cash. If it falls below something, they won't necessarily tell you what the number is, and you have to find it out by kind of guiding them through it. But that's when the queries come, and that's when they're more acutely aware of or concerned about what's happening in markets and with their investments, because you haven't taken care of that number.
I agree. Yeah, we have the same approach. I don't think rules of thumb work here. It is circumstantial, and it depends on the amount of money that you feel comfortable with in your bank account to say, no, I'm not stressed. If something came up, then then I'd be comfortable to look at that. I'd love to move across, if I may. Let's talk about the challenge that happens for heaps of people when looking toward retirement, which is that idea of balancing objectives.
Yeah.
So if you're in your 50s, for instance, and you're saying, okay, yeah, all right, you've convinced me. It's time to start focusing more on my retirement. Great, happy days. But you might also be saying, I just don't quite understand how I can do that and also pay the school fees. I don't quite know how it works for me to pay to my mortgage as quickly as possible. And how are you dealing with that?
I think one of the big ones that we do when we've worked with people in their 40s and 50s is realizing that there's certain years where you're going to go nowhere. We're used to just putting money away and saving it and watching our balance go up. It gets different when you get to retirement, when it just goes down, and that's a whole nother episode. But it's very much about knowing that you'll go nowhere and knowing at which point you have to start, really pushing on your super contributions or your savings. And yeah, if you've got, and it's getting older and older. So it used to be you could access your super for 55 in some way. Yeah. And now that's gone all the way up to 65. So the timing, it's 60 and then 65. The timing at which you can access it has extended out, and it's actually opened up a window where, in our experience, most people save most of their money or put away the most from like that 52, 53 onwards to 65, noting that you can keep putting money away as even once you've retired. So I think it's probably realizing that you'll go nowhere for periods, but also realizing that there's going to be a small window where you're at peak earnings capacity, you're probably full-time again, your kids have finished school, your mortgage is paid off, and that's probably like 50% of your, if you're at private school fees and you've got a mortgage, you're looking at like probably 50% of your income, if not more, going to that. And then it is that, can you justify the sacrifice for that 5 years to put money away versus not spending it now? I think most people try and balance both.
Yeah, there's definitely a time for thriving and there's a time for surviving, isn't there? And I think everyone intuitively has a pretty good sense for which phase they're in at the time.
You'd be surprised.
Yeah, I think that to add to that, the making sure that when you transition from a state of surviving into a state of thriving, that you're as effective as you can with your wealth.
Yeah.
And a good example is going to happen over the next few years, touch wood, which would be that as interest rates come down, people's cash flow is going to free up again. And most people with high mortgages may very well have said 4 years ago that they were certainly in a state of thriving here. I've got lots of money to do lots of things. My lifestyle's good. Everything's perfect. And that's really been clamped pretty heavily by the RBA.
Yeah.
So now we have this issue where we've got high interest rates and all of our free cash flow is gone. Well, as cash flow starts to get freed up again, the natural thing for most of us to do is to say, oh, thank goodness, let's relax, let's
travel.
Let's go and do all of those things that we wanted to do.
Let's buy the new car.
We're really, we'll be pushing our members really hard to say, take all of that and just keep banking it. Just try to maintain as long as it's manageable, maintain your standard of living. You've survived well. Thriving is going to look a little bit different because it will be financially thriving, but it allows us to offset the fact that we didn't thrive for the last few years, which is totally fine. Again, you're going to move in and out of those phases. I think a trap can happen here is that with these multiple objectives is that you can clear one objective and say, oh, thank goodness, and that frees up cash flow, and that is a really ripe area to make really poor financial decisions. And certainly if you're there, getting some structure around what you want and seeing a financial advisor is strongly suggested.
I was going to say that's probably the most important time and probably where the greatest opportunity. You start to get cash flow. You're able to put money away. So now, what am I going to do with it? And I think one of the biggest things, the biggest benefits that advisors don't necessarily talk about enough, is the ability to help people not make mistakes. And that, could be anything. Once you've got free cash flow, you're going to get offered all kinds of opportunities that you can easily go into. There'll be tips, there'll be timeshares, there'll be, all kinds of property, whatever it happens to be. We've seen it in the past, and it could be, it's a tax-driven, because you're paying tax now, it's a tax-driven investment idea. But it's having a structure, not necessarily, probably going against myself too much, not necessarily not everyone needs ongoing advice at this time, but putting a structure in place that helps guide you for the next 10 years can be incredibly important and help have a basis from which to make decisions and understanding where you're going to put that money or put it to work best. And I think one of the biggest mistakes people make is not understanding super. And we'll go deeper on this, but probably worth, how do you start thinking about retirement? And you can't really go past it without talking about super in Australia. You give us a big history on superannuation. Created by
well, thank you, Keating.
The Keating Hawke government in 1991.
I couldn't agree more in that if you're not utilising, if you're an Australian resident, Australian citizen, and you're not utilising superannuation as a vehicle for your retirement, then I just can't practically think of a circumstance where that would be a good solution.
Yeah. No-brainer, absolute no-brainer.
It is, yeah. The advantage of it being ideally tax-free upon retirement, depending on your circumstances, and then also having the freedom to be able to contribute and get tax deductions. And there's wins to be had, low-hanging fruit at the front end, and there's a heap of low-hanging fruit at the back end.
Yeah.
And as you pointed out astutely at the beginning, our system enables, the Australian system for superannuation for most Australians creates a huge amount of freedom and flexibility around where you invest your money and what you do with it. And all things being considered, given the level of freedom and flexibility, even if you're someone that's just sat on your hands and said, I'm not really sure what's going on with how my money's invested, with respect, that's definitely a mistake, and it becomes a bigger and bigger mistake as you get closer to retirement. But pleasingly, it still hums along in the background. For a lot of Australians, it will still continue to move along until you're proactive with it. And so I think that utilising superannuation and taking advantage of some of those benefits early has a monumental impact on where you want to go.
Yeah, it's just absolute no-brainer. It's like you can put money into super at basically no cost, no tax, and the tax rate in there is at 15%. Before you retire and start drawing a pension. Once you draw a pension, it's zero. And we get questions all the time. There's a $3 million cap that's been proposed. There's changes to contribution levels. There's always a little bit of tinkering with superannuation, but I'm confident for my career and for the next 30, 40, 50 years, it will be by far the best environment to put your retirement wealth. We'll go deeper on that in another episode. We love getting into the detail of superannuation contributions. Probably one other thing I had put together is when you're planning for the retirement, have you got any resources that you tend to, outside of financial advice, are there any resources, blogs, writers you lean on or recommend people take a look at?
You've completely stumped me here, mate. What are you doing? Look, no, not in a strict sense, but more so around really encouraging people to, as much as possible, consider what their retirement is going to look like. And we spend a lot of time talking about with them.
Yeah.
I think that speaks to the individualism of it all. And then also, ideally, to again, we'll talk about this, but the idea of not getting off that hamster wheel at full speed. You're not just working 5 days a week, 45 hours a week until you retire and then just calling it, because you can find yourself a little lost in that environment versus ideally slowing down 3 days, 2 days a week and having that free time to actually get into the nuts and bolts of what does retirement look like while I'm still at work.
And I think that'll be a long episode. Hopefully we'll get a guest in for that one, which is finding your why in retirement. Because you can have all the money, in the world. You could have $10 million and only be spending $100,000. But if you don't have purpose or a reason and you've lost, you're a manager in a business and you've lost all kind of relevance, well, it doesn't matter how much money you have and what you've done with your investments, you're not going to enjoy your retirement. So that is our experience would be that some people it works, they stop and they just go straight into 100% retirement and they're fine. They've got discipline, they've got structure. But for a lot of people, and it's becoming more common with the people that we meet, that they're more likely to continue working even in some sort of consulting or volunteer or more limited role and step their way in retirement. And in a lot of cases that stepping in last for 15 years. The only thing that gets in the way of it is travel. I did put you on the spot. I think, there's a few resources we use. I won't recommend the comfortable retirement lifestyle estimate, but there's some, things like Superguide. If you're trying to engage and you've got questions, you don't understand what's on your statement, and it can be hard to, there's only 15,000 financial advisors, and as we said, 100,000 people retiring every year. Superguide, Retirement Essentials, fairly good sources of general information. Again, if you've got any level of complexity, you need to seek advice on these areas. And then a number of books. I won't just say my book, but there's a lot of great books that talk about both the why and the how of retirement, which I think are incredibly valuable.
Come on, mate, plug your book. It's a really good book.
We're always giving out free books for the best question that people send in every week. So hopefully that acts as some sort of incentive to get some questions in.
I will personally ensure that book is signed copy.
By you as well. We're both going to sign it now.
That's inauthentic. I'll leave you to do it.
I think that's a good opportunity to wrap up this episode. James, thanks for joining me.
You're welcome. I'm going to fire a question at you here. If you're listening to this, what's one thing that you should do right now?
So I think I said last time, get all your statements together. I'm going to copy you and say, go look at your bank statements. Maybe put them into, there's a lot of different apps, and look at what expenses and what you've been spending in the big areas of those over the last 12 months.
Yeah. Okay. I'm happy with that. I'll let you through. All right. Let's kick on. Thanks, mate. Good chat.
Good to be here.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.